My guest today is Jack Bennett. Jack is the co-founder of Lighthouse Capital, a small to medium business search fund acquisition company that typically completes 10 to 15 deals per year. On top of that, Jack runs an accounting firm which does 8 million in revenue and 2.5 million in EBITDA. They've done so far 4 acquisitions and have 10 locations. And not only that, there's also disruption capital. So a lot is going on. Thanks a lot for coming to the Holdco Builders podcast, Jack.
Thank you very much for having me. I appreciate it.
As I said, a lot is going on. Could we start maybe one by one on what exactly are you building, and give us a bit of background before getting into Lighthouse Capital?
Yeah, sure. Absolutely. So I was born and raised in Canada in a relatively small city known for kind of farming, agriculture, etc. I had a great education my whole life. Went to a Catholic school from a very young age up into a Jesuit school through high school, which is basically a religious institution focused on teaching. And now I'm a student at the University of Manitoba, the local university. Really from the time I was 17, 18, I'd always been kind of interested in entrepreneurship. I was surrounded by a lot of people in my life who were very high income earners, but were employees and didn't always enjoy what they did. And I wanted that level of freedom, basically. So, I tinkered around here and there and failed a few times, and then found a reasonable success when I was about 18 doing marketing for extremely wealthy people on Twitter, basically ghostwriting. And from there, I was able to make a lot of great connections to a lot of wealthy people. And that's where, through that, I met my co-founders at Lighthouse.
Okay, and maybe tell me more about this journey, because those early days are always special. Like some people you met, like I'm sure some people really made a difference on your journey. So could you maybe share some more details of all this?
Yeah, I think the biggest, the best part of my journey that led me to where I am today is definitely my high school. Like I said, I went to a Jesuit high school with extremely high expectations of their students. And I was a student athlete there, and it was extremely difficult. You're looking consistent all-nighters, 2 to 3 hours of homework a day. We were in situations where we were taking, 10 exams that were worth, 30 to 50% of our grade each within a 12 to 15 day period. And you'd just have to focus on that. And that, I think, really taught me a lot of things that you couldn't get at other schools, because the expectations are just not there. And to be honest, I couldn't tell you a single thing I learned in science or math or history at that school, but I could tell you how to be disciplined. I could tell you how to make a plan. I could tell you how to stay on task. I could tell you how to focus, and I could tell you how to be able to say no to people when you have other things you need to do to improve your life. So that was really, really key. And then as well, when I was very young, it's hard to say for probably somebody, a child, but I would consider myself quote unquote overweight. And I think when I was about 13-ish, I really made a focus to get in better shape and improve. And I think those are probably 2 of the key points in my life that kind of led me to entrepreneurship and have allowed me to find success, just being able to put one foot ahead of the other every day and be disciplined in doing that, so you can succeed.
And when it comes to this agency serving those high net worth individuals, give me the story of the first customer and maybe the first 6 months, 12 months, and what happened then. Hi friends, Brandon and Spacebar Studios are my go-to team for demand generation. They are offering a special offer to Holdco Builders followers, a free 90-day growth roadmap for your business. Get 2 to 3 concrete steps you can take today to grow your demand generation engine. Head over to spacebarstudios.co to claim your growth roadmap, as there is limited availability. First come, first served. Now, back to the show.
Yeah, sure. So the first customer was genuinely through just DMs, basically.
What was the offer? What was
the offer? The offer was, I believe it was, the rule was I would post a certain amount of times per day for a 90-day period. And if I reached, I believe, somebody 5,000 followers, they would have to sign on as a client, basically. After that, to be clear, back then, Twitter was a bit of the wild, wild west. This was pre-Elon, it was at the beginning stage of the creator economy. So it was a lot easier to get 5,000 followers than maybe it is today. But yeah, just a few offers there, and then you're able to translate those people to clients. And honestly, that was probably the most difficult period of my life, because as a young entrepreneur, just a new entrepreneur, you basically have no idea what you're doing. A great quote is, anybody who actually runs a startup never wants to speak about it because it's just so bad. Like, it is just awful. And you make so many mistakes, and it's horrendous. So at that point, I was in university, taking a full course load, as well as working probably upwards of 50 to 60 hours a week as well. And that definitely was not the most healthy idea, but it definitely taught me a lot. And it really, the reason why that business is very difficult, there's only one person I know who sustained the business from when I was there to today. And the real reason is you need to get such scale to be able to hire great people. And I think the thing about people, when you're charging between, we'll call it like $3,000 and $6,000 a month, we'll call it, for your services, I think a lot of people went the sort of like, let's hire from like Thailand or wherever, in Asia or in other places, when the guy who actually hired in America absolutely dominates the space, and he's a good friend of mine. So it was a really good learning lesson. It taught me a lot of the basics about business, and it taught me a lot about how, people who are in that sort of ultra high net worth, or at least high net worth, think about things.
And now the transition from this agency business to Lighthouse Capital, what happened? How did it happen?
Yeah, so basically through Twitter, I met this individual named Ben Kelly. I don't run the socials at all, but I met him, and we sort of had an affinity towards each other. We had a lot of common thoughts, and basically, between him and a couple other clients, they more or less told me in a very kind way, you're a little bit too smart to be doing this marketing thing. They basically, I remember one of them told me, you're trying your best to make $250,000 this year. Spend the next 10 years trying to build something that makes you 2 million, at the time you're 30. And I think I realized that was a time where I wanted to look at other things. Finance was always an area that I wanted to excel in. And basically, it started with a proposal. I went to Ben and I said, I see what you're doing here. I think this is what you currently do in your business. I think we can do this add-on here. And he goes, that's a decent idea, but what do you think about this one? And that blueprint was Lighthouse Capital. And I remember thinking, my idea is awful. Like, what a mess. This is definitely not going to go very well. But ultimately, he said, well, I need people to operate it. And he connected me with a guy named Will Shaw, who's a former NFL player, and then ran a few tech companies, actually just exited one a couple months ago. And we basically started. And we started with an Excel spreadsheet and 2 people basically calling up business brokers, calling up leads, and going from there.
What problem were you trying to solve?
So what we were trying to do was create a holistic approach around individuals buying businesses. We saw that there were a lot of people out there who gave almost like modular solutions, which isn't necessarily bad, but we wanted to create something that was holistic, where people could walk in the front door. We could help them with, generating leads, finding the business for them, working with them through that business, and then working with them through the entire due diligence process in terms of legal, operational due diligence, financial due diligence, working with banking, lending, etc. To go through the entire process, start to finish, under one roof. Obviously, there are people that provide, QOEs. There are great lawyers and attorneys out there, even people who work with banks, but very rarely do you get that sort of holistic, full touch focus. And that was our goal. Additionally, we sort of predicted, and we're seeing this now, that multiples would rise, and therefore people would need more money down in the extremely lower middle market. So, sub $10 million purchase price, we'll say, where literally when we started, a business doing $1 million in earnings, like cash flow, would probably trade around 2.8, 2.9 million, depending on the business. Now you'd be lucky to get it for under, 3.25, probably closer to 3.6, to be honest. So we knew that people were going to have to raise money. We had access to investors who were looking to put money into SMB deals, and we felt like that would be a huge value add, which initially it wasn't as much, but now it really is turning into one, because banks are arguably stricter than they were when we started, yet valuations are increasing just because of market forces. So the goal was just to bring a holistic view to it and allow people to go through an entire process with one team, because I can definitely understand it can be very hard to, as an individual, operate all these different segments at once, and we wanted it under one roof. And then additionally, we've been able to give individuals the quality of lead sourcing, etc., that they just couldn't get themselves. I mean, we're spending multiple 5 figures a month just on lead sourcing, whether that be through cold email, various social media, we run ads, things like that, right? So I know people who do lead generation stuff for private equity groups and pension funds, and they're charging between $5,000 to $20,000 a month plus a back end fee, right? And that's not, you can't get that as an individual. But if we have 15 clients at once, then we can afford to do that for everybody, right? And everybody can get access to those better leads. I mean, the last 2 leads we signed, we literally just got a business under contract for someone we're working with last Friday, and that came from an off-market source, and it's a great business, makes nearly $1 million in cash flow, and we got it for a great price, 2.8 million. So we felt like we wanted to give that to everyday people.
And how were the early days? I mean, today you're doing like 10 to 15 deals per year. When you first started, how was it all?
It was unique, disorganized for sure. Our goal was, we were really fortunate that the Ben Kelly, the guy I mentioned, who I brought the idea to, he ran a company called Acquisition Ace, which is not really as kind of white glove, I guess, as we are, but it was basically more like an information, like course type, in terms of how to buy a small business. If you're, an employee looking to go into entrepreneurship using the SBA, things like that, lower middle market. So our goal really initially was, we knew we had people because there were people in Ben's group who were looking to buy a business, and we basically we need good leads. We need good businesses. So that's really all it was. It was just, I was handling the whole front end, basically pre-getting the signature of the LOI, and I would just handle, finding leads, assessing them, offering them if we liked them, negotiating it, etc. And then Will handled all the back end things, post LOI. And it really just started with really 2-3 people. We brought them in, and then we now switched to a model where people apply to work with us, because we just have so many people that want to work with us. I genuinely believe if we went based on our current capacity, we could probably book out 12 months in advance if we wanted to.
Guys, the business ownership journey is very lonely, and I've partnered with ScalePath to solve that problem. ScalePath has a network of over 2,000 business owners across the US and Europe, and if you book a call with the CEO, Rand Larson, today, he will introduce you to up to 3 business owners in your area. So again, go to joinscalepath.com and book a call with the CEO, Rand Larson, to get to know the 3 business owners in your area. Now, back to the show.
That's how many people want to work with us. So right now we try and keep it between 2 and 3 months in advance, just so that we can have some flexibility. But and now people kind of apply to work with us. And I think that's going to work out a lot better in the long run, because ultimately we've come to realize there's a certain type of individual who's kind of built for entrepreneurship. And sometimes that's not the wealthiest person in the room. That's not the most successful person in the room. Sometimes it's just the grinder. And because we have the capital connections, because also what differentiates us is we also invest in deals we close. So we have a really, clear vested interest in the business and that person succeeding. We find that the people who are more that kind of grinder type, regardless of their down payment abilities, as long as it's reasonable, are more successful.
So in Lighthouse Capital, you also have this strategic roll-up division, as you said, once in a while investing in those deals as well. How does it work? How is the structure there, and what type of businesses you're looking for, or how many of those you do per year, let's say?
Yeah, so currently we have one strategic roll-up. We're in discussions past sort of like early phases, I guess, with another. Basically, we're looking for operators who we believe are very talented, that have usually $1 to $1.5 million of EBITDA already, and that are looking to kind of expand to between 4 and 5 million over the next 3 to 5 years approximately. And what we usually do is we make an investment in that company for an equity stake that can help them, fund their next acquisition. And then we do all the basically merger and acquisition side, because that's our bread and butter. And then they handle the operations. We're really fortunate also. My business partner, Will Shaw, as I mentioned, he has a tech background, and he has experience, leading teams of between 30 and 60 people, and literally starting companies from zero to $20-30 million valuations. And ultimately, we can advise them in terms of, for example, what we're going through right now with our current roll-up strategy is we need to bring on people in the C-suite. And we can advise them on, okay, who should we bring on? Why is that role important? Who can wait in terms of, CFO, CTO, COO, etc., as we're starting to scale.
When do you decide to invest in a deal versus just advising it?
Yeah, so there's a few things. First and foremost, it at times will come down to the actual acquirer themselves. Sometimes they simply have all the money they want, and they don't want an investment in the deal, which is totally understandable, and that's not a problem. We have an operator right now who was a great operator. We just closed with them 2 weeks ago, and they, I think, had 75% of the down payment. They'd already bought a business, and they had an investor as well who said, hey, the first one worked out, if you ever buy again. And they decided that would be a better fit for them because they know the investor was loyal to them, well before they even knew who we were. So sometimes you just don't have that opportunity, which is a shame. But ultimately, it comes down to the person. If I could give advice to people who want to invest in SMBs, I wouldn't care about the business too much. I'd make sure it looks good and all that, but I'd absolutely grill the operator, because that's what's going to make or break it. If they want to be absentee, not part of the program, etc., versus the people who are actually going to put in work, you want the people who are going to put in work, because ultimately, an SMB doing less than $3 million of EBITDA is going to have a high reliance on the owner, and you want to see people with that general work ethic. And that's really the most important thing for us.
And what were the initial conversations, and maybe why did you decide to build like both an M&A advisory arm and the roll-up engine under one roof? Because obviously there are many M&A advisory firms which are not doing that. There might be a reason for that as well. So why you are different, and why you decided to go down this route?
So we really like the fact, like our vision, like our statement is always, our job is to create transactions that build generational wealth. And that's basically our goal. And because of that, if you're building generational wealth, you're dealing with people who clearly don't have generational wealth before. So we really pride ourselves on the fact that we can be that sort of sub $10 million player for people and not just work with PE groups or family offices, etc. But we also wanted to find ways to create great value, in the long term with experienced people who maybe were already past a few phases. Because, for example, if we have great operators that we work with, but if, you get an SBA loan today, you will probably not be able to go and continue to get approved for them consistently. So we need businesses of a certain size in order to get some form of unsecured lending or lending just secured against the business. Our long-term vision really, it sort of fell into our lap, to be honest. Now that we're more in it, we understand the value of it because we can see sort of the multiple arbitrage and our expertise. And we can see that people, like I said, who make between $1 million and $1.5 million of profit still can't afford massive M&A teams, stuff like that. And it's much more convenient to give us equity. So the roll-up strategy continues to align with our vision to create generational wealth. It just put a bit of a different dynamic into it. And then additionally, it allows us for a little bit more of a consistent revenue source as well. And it also allows for us to potentially get a very large payout once every 3 to 5 years. And those were things that were good for our business model because early on in our business, we have a high monthly recurring revenue, not necessarily from roll-up division, but initially we were literally just transaction based. So we would close a deal, get anywhere between we'll call it $250,000 and $500,000 check. And then, when we were early on and our deals were spread apart, we would have to wait, 3 months to get something else, right? The roll-up division allowed us to sort of understand our cost better. We also have a very fair offer, which I think people appreciate. For example, the individual we're currently doing a roll-up strategy with in the accounting space, he had an offer from 2 other private equity groups, but they were sort of like, yeah, we'll buy your business, give you 20% and then do this with you. Well, from our perspective, what we did was I believe it's a 2.5 or so year time train. And for every basically $1 million of a deal we transact on, we basically gain 1% of equity up to a certain cap. But if he, sells before that 2.5 years, so we wouldn't have had the time to make all these, investments, we'll call it, then, we automatically basically get that full cap. So I think he found that to be a very fair structure that allowed him to continue to partake in upside. And that's exactly what we want to do. In the other structure, based on where we would be now, in the other structure, he would have got paid maybe $2.5-3 million initially, and then his stake would probably be worth another probably $2.5-3 million right now. And under our structure, he didn't get paid early on, but he got an investment, and now his probably total is worth around $8-10 million ish. So I think people really appreciated that, I guess.
You said some of those sellers and buyers, they don't have large enough M&A team when it comes to expanding and doing maybe additional acquisitions. How large is your team today?
So we have myself as the head of mergers and acquisitions. We have Will Shaw, who basically, I would say he sort of generally manages everything, as well helps on the investor side. We have a director of operations who helps us on obviously the operations side for due diligence. We have somebody else in the operations team who helps with flow through as well. And then right now we have basically partners, I think is a good way to put it. So people who are either fractional to us or are mostly work with us, such as we have a legal partner. We have one individual who I guess they'd be considered a contractor, I guess, even though they live in the United States. They do all the quality of earnings, things like that. We have a lending partner who helps basically source different deals and different banks to help our operators get the best possible fit. And then we have, depending on the situation, we have a couple other people on the due diligence team. So It's probably a team in total. Every deal will have about 7 to 9 people like genuinely touching, having their hands on that deal. And some will be up to maybe 11 or so.
For how many years have you been doing that so far?
So we are approximately 20 or so months in, so just under 2 years.
Talking to other people, how common have been this type of strategy where you invest once in a while in some of those deals you're advising?
I'm currently not aware of anybody else doing what we're doing. There are obviously search funds, right? That is the, I don't really want to say competitor, but that is the main, I guess, adjacent sort of type of business to us. But most search funds are not looking where we're looking. Most search funds are, 3 million plus in EBITDA, etc. And we more compete with search funds in our roll-up strategy than we do with our sort of M&A advisory division, you could call it. So I'm not really, when we were doing it, I was aware of one other person, and that's currently who I'm still aware of, but I'm not aware of anybody else who is more kind of institutionalized and not either a 1 or 2 person team.
What about you, Jack? Like personally, you doing this together with people who have more experience. How is the team dynamics when it comes to strengths and weaknesses and your own strengths and weaknesses? Like what do you prefer doing? What do you maybe don't want to do that much, and what are you excited about?
Yeah, exactly. So the great advantage of our whole team, at least at the leadership level, is we've all owned a business before. So we fully understand what small business is like. I would say my strength lies with probably the lead side. That is what I prefer to do consistently. It's where I have the most connections. I would consider myself relatively personable. And I think a lot of brokers and sellers like that. And that's something I'm very capable of. Our director of operations had a background in the Army and then military intelligence. So he's very good at systems, processes, etc. He ran a very large team in the Army of, I believe, 30 plus people. And he's extremely good at all those sort of back end things, saying when this occurs, we need to do this. When X occurs, we need to do Y. When A occurs, we need to do B, etc. And then Will's great because he has a great holistic view of everything. I would say him and I have a lot of investor network connections, both from myself and my previous business, and then him. He's raised a lot of money from the tech industry, so we can provide a great deal of utility to our company through those connections and people who want maybe more alternative investments. And I think also what Will brings that's great is he has gone through the exact process all our people go through. Will has bought a business through the SBA. He owned that business for a few years, and then he divested that business as we were sort of starting Lighthouse Capital. So I think each of us brings something that's relatively unique to the scale. We all come from very different backgrounds, and I think that's good as a team. But I think the best part about our team is that when you look at myself, our Will, and our COO, we're kind of like the leadership team, but we're not afraid to be overruled by anybody below us. If they can come in with information, that is good. Nobody in our team from top to bottom is afraid to put their hands up and say, I think your idea is better. And I think that's been really important because these deals, as I'm sure are very fluid. It's hard enough to get a deal done, even $100 million, multi-billion-dollar deals. This isn't Apple buying Google, right? It's Jimmy buying John. So those deals are going to be messy, and we have great discussions multiple times a week about how to move forward on deals. And nobody's afraid to be wrong, and nobody's afraid to make their idea or say that their idea is second best.
I forgot to ask before, when it comes to this structure, when it comes to, for example, buying or investing into one of the firms you're advising. So do you convert your fees into equity, invest additional equity? How does it work?
Most times we will convert a substantial portion of our fee into equity. That is 9 times out of 10 how it's going to go, for 2 reasons. Number one, kind of talked about it with investor before. If I'm investing in an SMB, I also want to see capital. I also want to see skin in the game from that from the operator. Obviously, for example, if you're doing an SBA deal that is personally guaranteed, absolutely not legal advice at all. But I do know people who have defaulted on SBA loans, fortunately, not our clients, and they have been able to get away what I would call relatively unscathed in terms of they keep their house, they're able to keep a decent portion of their investment account, retirement accounts, etc. So you want people that what they lost mostly is their down payment. So you want people with the down payment. And like I said, I cannot be clear enough. That is not legal advice in any capacity whatsoever. I don't even have a college degree, so don't even look at me for anything like that. But ultimately, you want to see people with some skin in the game. And because of that, there's really no need ever for us to make that extra sort of investment, because usually that person, if they need $300,000 down, usually they're putting 200,000 and we'll put in 100,000, something like that. Or we'll put in 50, help them raise 50, etc. We try and spread our bets out as much as possible. Obviously we have things that we want to go and deals that we want to invest in because we believe in it. But ultimately there's a reason why you hear people who get 10, 20, 30x returns on their money within, we'll call it 3 to 5 years, right? And it's because it's risky, right? Like I always give this example, and sometimes it's not put into context well enough because people throw out big numbers all the time in this day and age. But if I went on ChatGPT and I said, give each company on the S&P 500 a lottery ball, and I'm going to hit go, you're going to give me the lottery ball and the company, and I'm going to have to invest in that company for the next 5 years, versus I'm going to have to invest in an SMB for 5 years because it's not liquid. The odds of that SMB failing compared to the odds of that company in the S&P failing, it's like 300 times more. And I think people need to realize it is literally 300 times more. Now, obviously, one of the biggest 500 companies in America, the likelihood of that is extremely low, but the S&B is much higher, even though it may not be it may not be 50, 60, 70%, right? But it's still extremely high. So you want to look for people who, like I said, are grit grinders, and they want to put money themselves, in the deal. That's incredibly important. And we want to spread our bets out, because if we make 5 investments, one is definitely going to zero, like 100% it's going to zero. A couple, probably 2 are going to be either break even or make a little bit, but based on the risk reward, you would have rather just put it in a market, even just like a treasury account, basically. And then you're hoping one of them can probably give you like a 3 to 5x return, and you're hoping one is like 10, 20x, right? That's really how it goes. So if anybody's investing in SMBs, definitely I would recommend spreading your bets out, because like I said, the odds of an individual business, even though to be clear, the odds of failure are not 50, 60% anywhere close to that, compared to really any other investment in the book. A small business is highly, likely. So to put all your eggs in that basket as an investor is not great, but that's what you want to see out of the person buying the business. You want to see they're committed. You want to see that they're, for example, we have a client right now, the loan he's taking on, he could pay it off today. He's got so much money. So it's like, is that guy, of course, and he wants to run it more sort of like remotely, less hours, whatever, which is totally his prerogative, but that's not something we would invest in, because he has no incentive, right? If he succeeds, great. But if he doesn't, he's just going to pay out the loan and we're done. So you want to see people with skin in the game.
How has running both M&A advisory and roll-up division changed your perspective on deal quality, ownership, and control?
It's really interesting. In our roll-up strategy, sometimes I find that we don't, we need to really use, the key to keeping discipline is to basically take each business and analyze it as its own individual entity. And a good example I'll give is when we were first starting our roll-up strategy, we were doing about $1 million in EBITDA. That was the company that we sort of took part of. And if we're buying a business that makes $500,000 in profit, let's say, I think that business in the accounting space is probably worth, let's call it $1.5 million, something like that. There's no reason that now that we're trading at a higher multiple, have, over close to $3 million of EBITDA, that business is still not worth necessarily 1.5 million, right? It should still be the same no matter where you are. And it's really important to stay disciplined in that, because we get into a trap where it's like, oh, we're trading at 5x, 5.5x, etc. So we can afford to overpay that extra tick of EBITDA, that extra half tick of EBITDA, because we can still make it up. But that's not a good way to go about investing. So we try and be as disciplined there as possible in our roll-up strategies. Regarding looking at the quality of businesses, I think one of the biggest problems is people look at a lot of, and maybe it's because of some, core sellers, etc. But people look at a lot of businesses as like, what's it going to make me my year one, right? They always talk about like, how much am I putting down for, what's my return? What's my cash on cash return? Because the number is so high, obviously, because you're taking on so much leverage, 80, 90%. So people always look at that, but we try and look at, when we look at the quality of the business, we try and look at how's it going to perform over the next 3 years, right? Or the next 5 years, because there's definitely going to be 1 year in the next 5 years that's going to suck, right? And what I try and tell people, especially people who will say like, oh, last year was a really bad year, or this year's not looking as good for business, etc. That's great, right? In those type of years, you're not going to be flourishing, right? Your goal in those types of years is to make a little bit of money and make sure for you, because you're taking on massive leverage, that you can pay off that debt, right? And that's ultimately something that I think a lot of new buyers don't look at well enough, because they're going to be bad years in business. It's not just up and to the right. And I actually think if a company's having a slightly bad year and they can explain why, I actually would arguably take that over something that's just up and to the right, because I find in these types of environments, nobody will really lie to you, but they will omit things. So it's your job to really press on things and take the initiative to press on things in order to identify what's a good business and what isn't.
So what are the pros and cons of this strategy? Again, having this M&A advisory roll-up division, you're 20 months in. What have you seen? And again, what are the pros and cons?
So the biggest pro is our deal. We don't have to necessarily source investment deal flow. We were always going to take a certain percentage of our fees and invest them into businesses. And one of the biggest pros is we don't really have to do anything on that side because the deals come to us. The other pro is that, to be honest, at the current time, we are the preeminent business, at least that I'm aware of, in America that does this. So that's great because we feel really confident in the services we provide, and having the duality of being able to build something for the long term, as well as being able to help people on day-to-day transactions is really, really, really great, to be honest. So I think we do a great job of being able to really play in both sections of the market. And frankly, our roll-up strategy actually provides us with a general amount of stability to our business, which is something I didn't really think, because obviously that business cash flows. So that's convenient. And then also, instead of charging, massive fees, we just charge basically like a monthly retainer as well as part of our agreement with that operator in the roll-up strategy. So that really, really, really helps us in terms of, like I said, when our M&A deals are not closing as quickly, or, how things go, they get delayed, 2 weeks here, 2 weeks there. We never have any cash constraints on our business. The biggest negative, I would say there are two. The first would be around our perception, or how we are perceived by some sell side brokers. We've been really fortunate to work with some terrific sell side brokers, which has been really, really amazing because they understand the value we bring. And, now, for example, this year we started doing broker surveys when deals maybe didn't work out in due diligence or whatever. And the feedback has been really, really positive. But sometimes, especially in the lower middle market, being the only player, being the predominant player can work against you because nobody knows what on earth you're doing because you're the predominant player and there's nobody else who's doing it. So that's been something that we really have had to kind of massage. And particularly when there are holdups in deals, no matter where the blame lies, ultimately it comes to, you guys are supposed to be the experts. That's why, the broker's like, that's why I let you in my deal, things like that. And that happens from time to time, even though it's not, it's not as common anymore. Initially, it really, really was. And that's disappointing because I think we can provide great services to offer. And those are relationships that not maybe on our end were ruined, basically. And that's a shame because we have a great buyer pool. Like I said, we have a ton of applicants for working with us. We take a very specific person with a ton of money to put down that's also, more often than not willing to put in at least, 30 hours plus in the business. And those are great buyers ultimately. And then the second thing that can be difficult at times is just the cash conversion cycle of our business in terms of, we are taking a lot of upfront costs typically for a large deal fee at the end. Now we began to charge a little bit upfront just to get people's sort of skin in the game. But ultimately, there are times, like I said, our OpEx is probably, north of, it's probably just a little bit under $1 million a year. So, ultimately, that's why the recurring revenue is really important to us. Because if we don't, close deals for certain periods of time or they get delayed, no matter really where blame lies for that, ultimately, it hurts our business slightly.
Do you recommend this type of investment strategy for other advisory firm? And if yes, what type of skills are maybe required to do what you're doing?
That's a great question. Do I recommend it? Sure. Yeah, absolutely. I think anytime you can continue to align yourself with your clients, particularly when you're an intermediary, I think that gets everybody on the right path and it works out long term. That doesn't mean every deal will work out long term, but it definitely aligns everybody. The problem is that sometimes when we make investments, you have to be really careful about making sure that expectations are set as to what this investment is. For example, in our M&A advisory deals, if we're investing in the business, we are literally we are cash for equity, and I will see you at the first board meeting. That is what we are. We are nothing else. We are not there to hold your hand after you run the business. We will guide you through the transaction. We're giving you money, so we clearly believe in you, but we are not there to hold your hand after the transaction. Versus in the roll-up strategy, obviously we're very involved, right? And I think sometimes those lines get blurred because we do a great job to help people complete the transaction. I think sometimes we're so with them as part of the process, they almost expect that after the transaction. And it's really important to set those boundaries because ultimately I don't have time. I couldn't imagine my schedule if I had to go back and check in on everybody, every week to see, what they were doing and things like that. And that's why it's so important to invest in a good operator because you're expecting them to do that. And, we've had situations where, obviously in dire situations, we'd like people to reach out to us because we have a lot of connections, etc. But ultimately, people need to understand exactly what we're there for. And in that case, we're there purely for dollars. And we expect, general financial reporting as any investor would, but nothing too crazy. Sometimes those lines get blurred and sometimes we need to reiterate that after the investment is made. And other than that, I think it's pretty good, except for obviously the fact that, you lose some cash flow up front. For example, in the last couple of weeks, we've decided not to invest in a few deals just because we think we may have a second roll-up strategy, which is more advantageous to us. But ultimately, if I was a broker, I would recommend it because usually it will allow you to charge more. So then when you're making the investment, you're actually almost netting even. And additionally, it gets everybody aligned and it creates incentives. And like I said, it really goes back to what that company and that advisory firm's vision is. For example, there's a great lawyer in my city. And he's very wealthy because obviously he's a great lawyer. He works on M&A deals as well. But what he did was he started rolling over some of his billings into cuts into the new business. And, obviously it's gone very well. So basically, like I said, it really starts with our vision of helping people complete transactions that create generational wealth. And we want to be a part of that for the people that we work with. But like I said, I would tell the M&A advisory firm who was interested in trying to do this, make sure you've set expectations and make sure you spread your bets.
You're young, and I guess you're the youngest on the founding team.
Yes, by a good margin. Yeah.
So what about the risk appetite when it comes to this investing side with Lighthouse? Debt equity ratio when doing those deals. What is your approach, and is it sometimes different from your other co-founders?
Yeah, so in terms of, there are definitely differences between Lighthouse and Disruption Capital. In terms of Disruption Capital, I own 100% of, basically like a personal holdco is a good way to put it. And there, the appetite is definitely different than my founders. I would say we're mostly generally aligned. Like I said, one of my co-founders in the tech space, there you're looking at relatively high risk investments as well. Ultimately, we're usually quite aligned because we work, even though the risk appetite might be a little bit different in terms of how much do we want to put, how much not. In terms of yes or no, we're pretty aligned. Like you can tell when working with people if they're going to be, if they're going to be great to invest in, if they're going to be a risk, basically. And I can tell almost immediately within 2 weeks of working with somebody if we're going to invest in them, as can our operations team, because we're spending so much time with them going through it. And these deals, similar to what we talked about, they're not up and to the right. There are times when a deal is looking great and then it goes down a little bit and then it looks great again. Then any deal is going to have ups and downs, and we can just tell by working with them, with their temperament. I mean, for example, we had an individual who is a very nice person, but they basically were in the middle of doing some financial reporting, and some numbers came back initially lower than what we anticipated during financial due diligence. And that person emailed the whole team, just absolutely losing their mind. And we're like, QOE started yesterday. Let's just see how this goes. And sure enough, the P&Ls did not have any add backs in them at all. Did not even not even close, not even remotely close to what the final numbers came out. The QOE ticks out and suddenly it's basically right in line. I think it's 2% lower or something like that. And that obviously doesn't warrant a price change because that's just a nominal number. So it's that person, there's no way that person is somebody that we would invest in. And that doesn't mean that they would be successful. But when you go through the process with them, like I said, our average person is finding a business within, we'll call it 120 days or so. And then they're going through a whole nother process for 90 days to actually close on the business. So we're working with our average client for 6-8 months through ups and downs, goods and bads, high moments of optimism, moments of pessimism. We know exactly who we want to invest in because we have a very clear archetype. I think I've said it a lot. We want to invest in grinders, people who are willing to work in the business, do what it takes, and who really put the time into it. We're not looking to invest in people who want to be absentee, which is, in my opinion, not a good way to run a business.
One of you're talking about investing in grinders before asking who is the grinder and who is not. One of your current focus is also the accounting firm. As I said, generates approximately 8 million in revenue, 2.5 million in EBITDA. You've made 4 acquisitions and you have 10 locations. This is under Lighthouse, right?
Yes, yeah, exactly.
Okay, so tell me the story, finding this deal, what is the decision and the reason behind this investment, how is it doing, and maybe investment side, did you convert these fees into equity and added additional equity, or how has it all been?
Yeah, so this deal came to us because one of the members of our executive team knew this individual. 2 of the 4 members of our leadership team are from the Army, from the U.S. military. So this individual also was from the U.S. military. And after he left the military, he had a CPA and he started accounting firms. And what we really liked about him was he already made 2 acquisitions himself. So he went from he made 4 acquisitions himself. So he went from 1 location to about 6 just himself, really cornering a very small part of Texas, basically, and just kind of ran the shop there. And we really, really liked that. He was being approached by a private equity group who wanted to buy him out and do some sort of similar roll-up, but he wasn't really a big fan of them. And like I said, they were going to give him like 10, 15% equity. And he was like, not in love with that either. So basically, we just made a proposal for a little bit of an equity injection, and then also basically just, we'll call it a service for equity, more or less. But like I talked about, where every $1 million of transacted value, we get a 1% basically, up to a certain cap. And he really liked that idea. And we really liked him because he worked really hard. He'd shown that he'd been able to make acquisitions and integrate acquisitions, which is by far and away the hardest part of doing a roll-up strategy. Has nothing to do with the merger and acquisitions. It has to do with the integration, particularly in small business. And we knew he was capable of doing that, so we felt like it was a good investment. So we really started working with him, and I think it's been a really good success so far. Obviously, it's not always roses, but ultimately, for example, a few months ago, we received a large sort of lengthy line of credit on a deal-by-deal basis from a bank that I believe it's either high 7 figures or low 8 figures. And one of the core reasons for them giving that line of credit to the business was because of us. Because he said, they'd done 2 deals with that bank in the past, one with us, one without us. And they said, since you've brought on this team, since you brought on these people, you've really, we can see the step up in quality. It's a much easier process for us. It's much more organized, etc. So it's been a great partnership working with him. But ultimately, we liked his ability to integrate. And we liked that he already made a couple acquisitions. He was generally familiar with the process, and he had some great businesses to start with.
And how has it been for your team when it comes to a post-acquisition? Like how much time it requires from you to work with this partner on this accounting firm?
It comes in phases. The things about the accounting firms are basically you're not doing any transactions from March 1st to basically June 1st, June 15th, right? So really what you're looking to do is you're looking to pick off a few firms. Well, actually, I guess I'll start after tax season. It's probably a better way to put it. Through summer, which is the dog days, basically, it's pretty hard to get a transaction done if you don't have something under contract, because accounting firms are the least busy by far. Everybody's on vacation, kind of a mess. And basically, we see if we can make one acquisition, usually during that time. And then there's a tax deadline in the United States. There's one in September and one in October. Most sellers are not looking to sell there because they want that revenue, basically. They'll tell you whatever reason in the book. They're busy, they're this, they're that. There's a tax deadline. They get revenue by completing that, basically. That's where a bulk of their revenue comes in. So that latest deadline is on October 15th, usually. And after that, basically November, December, January, and February, that's your time basically to make a push. So for example, right now we're working on closing, I think, 2 firms to kind of add on to the few that we've acquired this year. And we're going through that process with the bank right now. We've had it under LOI for a while. And for myself, who sort of helps that operator and works with him to help source leads and put LOIs in, etc., I probably have not worked on that significantly. Here or there, obviously, I had a few calls, things like that, to check out some businesses, called some brokers in the space I knew, but nothing really that in depth. This is more time for the operations team to close a couple deals that have either been pushed back through tax season because we couldn't close in time, even though this year we actually did close all of them in time, or we got agreements done before tax season and we're just like, let's just push this back because nobody has time during tax season. So it really comes in waves. I think one thing we're looking to do is remove ourselves a little bit from the integration, because we've integrated before, and we've helped the operator integrate before, but we're big enough now. It's time to hire probably a CTO or COO or something like that, and move our operator from being a CPA who also has, 7 locations to the COO of all 10 locations, basically. And that's what we're working on doing right now. But for our team, it really comes in waves, basically from, we'll call it May 15th to July 15th, pretty busy. From July 15th to like September 15th, October 15th, not as busy. And then it's quite busy from, we'll call it November 1st, December 1st to March 1st.
Now you brought out the importance of integration. What have been your lessons? And maybe if you can say, this person is really good at, what makes one person good at it and others don't, based on your previous experience?
Sure. So I'm not on the integrations team, but I've obviously seen a lot of transitions throughout both of our divisions. Really, the integration actually starts the moment you get the business under contract or the moment you look at the business. And I don't think enough people understand that. Every question you ask is going to change or in some way influence the decisions you make post-close on integrating the business, right? And that goes from anything from when I'm asking an accounting firm, what tax software do you use, right? If they use Drake, then we are going to have to change that because we use Lacert, right? If they use Lacert, great. For your accounting clients, are they using QuickBooks Desktop, QuickBooks Online, right? Those are 2 separate versions of QuickBooks, and it's important to understand what they use and what most of their clients use, right? Because most of our clients currently are using QuickBooks Online, right? So that changes how you integrate things. And it's really important to, as I mentioned before, sellers don't lie, they omit. So you got to press on things to get answers. And then when it comes to integration, one thing I think we do really well is when we go to a new location, after we bought the business, we're a little bit fortunate because we're an accounting firm buying an accounting firm. So there's not that much, we're credible ourselves in terms of like, okay, these people know how to run this business and it's not going to drop to the ground. But we allow every employee, from the person at the front desk to the best CPA, a full sit down with the CEO for as long as they want. And we discuss anything from their personal lives to what they like about working here, what they don't like about working here, what their current role is, where they see themselves in 5 years, what's the education they're hoping to get or that they have, did they like it, not, etc. And I think that in our business, in terms of accounting, just brings people calm, right? Like if you look at most people you have to understand also who you're talking to, right? If I was trying to integrate a plumbing company, I definitely would not have a sit down with, some tea and talk about the fancy degrees everybody has, right? I'd probably do something else, right? But for the accounting firm, even though some people talk about technology and stuff like that, most technology right now is pretty bad, to be honest. And additionally, there's also compliance issues with it in terms of like who is responsible for certain things. Like if the AI messes up, is that on the CPA who signed that mess up, or is that on the AI company, things like that, which I believe is getting figured out in Washington right now, or they're trying to at least. It's really about people at this point, right? It's about understanding those people. What do they do? Does somebody who works in tax want to work in accounting? Does somebody who works in accounting want to get their EA to work in tax? Why? What's their motivation behind that? And typically after those conversations, you can get a real good picture of what you're looking at. And people really, really appreciate that, because when a new business gets bought, the first question they have is, who's the buyer? Okay, it's another accounting firm. Oh, that's great. That's like the best possible thing that could happen. So what are they going to do? Are they going to cut people? Are they going to reduce headcount? Are they going to cut wages? What's their bonus structure? What's their benefit structure? Things like that. And it's really just about being vocal with that from day one, because if you're not vocal, you don't want to give people a reason to leave right away. Most people who don't leave after about 30, 40 days are not going to leave in the next year. Like that's just the reality. So you just want to go out and talk to people, and integration starts from the first time you meet that seller and start asking them questions. Because, for example, a firm we're integrating right now, I asked questions in December about it. That report was sent to the CEO, who then knows when we buy the firm, these are the things we need to change. So those are really things that are important. Our business currently is a very human-based business, and ultimately, we want to make sure that those humans, those individuals, feel comfortable with the new ownership.
Jack, you are young. You have a lot of time to compound more and longer than your older partners and colleagues. So my question when it comes to capital allocation on your own personal view, what you think will generate the best returns for your hard-earned fees? Is it doubling down on this accounting firm, doing more add-ons, growing into XYZ, or investing in other industries, other companies which you've seen? So what is your take on that?
So the accounting firm produces a high, obviously, return on investment, right? But I think it's hard to give a landscape based on Lighthouse Capital. In terms of when it comes to that business, that's probably a different conversation than, for me personally, right? Because I'm a co-founder of Lighthouse. I would call it a larger equity stake in it. But I in no means own 100% of it, right? So ultimately for Lighthouse, our goal is, if we can close directionally 10, 15 transactions a year, and then also, facilitate the accounting roll-up, and then our goal is probably to work on 2 roll-ups at once, probably stagger them about 2 years away from each other, so that we're getting kind of one payout every 2.5 to 3 years. That would be the most ideal. But to be honest, at Lighthouse is something we're discussing right now, because to be clear, my partners are older, but they're not that old. They're in their low 30s, right? They're between 30 and 33 basically. I did one of them a favor because he's definitely older than 33, but ultimately, that's, they're not that much ahead of me. I would say I'm probably 1.5 compounding cycles ahead of them, which does change my investment view. And additionally, I don't have incredible expenses like they do. Each of my partners has between 2 and 4 kids, etc. I don't have any kids, obviously. So it does change things a little bit, but it's something we're discussing right now. I think long term, we want to continue to double down on things that we know succeed. Our best probably investment would be if the accounting firm has a big acquisition and needs to raise more money, it's to make the investment in ourselves through there is probably the best opportunity, because the business is more stable. Our investor terms are great. And we know that. I'm actually personally considering making an investment as well if there's a new raise aside from just Lighthouse. And I think that's our best way to compound capital, because it combines a very strong return with a significant amount of safety. And just because the company's larger, and compared to our other investments, the LTV is only about 60%. So because of that, it gives us some safety, and that's probably the way to go. I think long term, like I said, that's a division we want to continue to build out. We probably do need to change our structure a little bit, because we've learned some things through this run. But I would say the roll-up division is really sort of long term what's going to make the most amount of money if we can dial that in.
Jack, I have so many follow-up questions, but I want to do a round 2 with you very soon, because a lot is going on. We could have discussed today the third business, which is disruption capital. Let's leave this for the future. But 2 quick questions. What is your favorite book, and what is the best investment advice you've ever received?
Oh, that's a good question. So I'll give 2 answers on the book. I'll give the cheesy answer of somebody immature like me, which is probably Harry Potter. But on the investment side, I would say How to Make Friends and Influence People is the one that's had the biggest role on my life, or the biggest kind of impact on my life. And it's one I use that book every day. Additionally, I would say rich dad, poor dad probably was what was one of the big parts of entrepreneurship and just getting an understanding of assets. In terms of investment advice, that's a great question. First of all, I want to say I look forward to being sued for whatever advice I'm about to give. But ultimately, I would say get your bases. Actually, probably the best investment advice I have is actually just live below your means, probably. Because the more you invest, like, I think you probably have a more diverse listener base in terms of high net worth, accredited investors, things like that, right? But if you're not an accredited investor, more or less you're barred from a lot of investments. And ultimately it's about living below your means, and that is going to allow you to invest more. And ultimately, if you invest more earlier, you're going to see a ton of returns. When it comes to accredited investors, people making these kind of, we call it alternative investments, I would say for every dollar you invest, take 20% or 25% and put it to the side and use that, pool that money to double down on your best investments. Like, that is something I've really, really learned. Like, similar to the Bluestone acquisitions we've made, where with our accounting firm, where basically, we're at a point now where we are doubling down on something that's successful. We feel really confident making that investment. We know more about that business than any other investor could, because we're in that business consistently. So if you're putting $1 down in investments, definitely put 15 to 25 cents on that dollar aside to double down on your winners. Because ultimately, like I said, it's gonna be awful. It's gonna be a write-off. 2 are going to be decent, but if you can double down on the ones that give you the 3x or the 10x, you can really expand.
This is great. Never heard this before. I just took notes right.
Thank you.
Jack, let's stop here. Let's do round 2 soon. Thank you for your time, and talk to you soon.
I appreciate you having me. Thank you.